Okay, call the Investment Advisory Committee to order. Roll call, please.
John Kennedy?
Tony Badalamenti, Sabrina Kristen Bennett is absent. Motion to approve the minutes from regular meeting, September 26, 2024.
I'll make the motion.
And I will second that,
Okay.
and that is so ordered. And let's see.
Portfolio update.
Okay, portfolio update. Mr. Kennedy.
Go ahead.
Yeah.
Yeah.
I was waiting for him.
Oh, and the other thing I will let you both know, and I think Eileen, I told you this already. Tony, I know you're very interested in the weekly market commentaries. I put the last two in here before she gets going.
Okay.
I think it's important to take a look at that because it talks a little bit about the recent Fed activity.
Yeah, they've been changing.
Yep, they have.
And I'll leave that up to you, what's gonna
Yes.
happen in the next 6 months.
Right, right. And
Eileen.
then, go ahead. And then the report itself is underneath
Okay, thank you.
the 2 weeks worth of the weekly market summaries, and then you can go right to
Yeah,
here.
'cause that's been very interesting the last 2 weeks. All right, Eileen, you're up, please.
Yes, absolutely. Well, hey, thank you very much. I really appreciate it. Merry Christmas, Happy New Year.
Merry Christmas.
Happy
Feliz
holidays.
Navidad and all that
Happy
stuff.
all that good stuff.
Ms. Tinlin, would you like to join us?
You have enough?
Yeah, we always have enough, but you're more than welcome to join us.
I'm good.
I got a seat for you. I got a packet for you.
I'm good.
All right, Eileen.
All right.
It's always good seeing you.
Thank you. But yeah, definitely, it's interesting that we are having our meeting the day after the Fed met and made
Yes.
their decision.
It's great timing.
I said, note to self, it unfortunately gives, our material is prepared in advance.
Yes,
So, some of the information is what we would call stale.
Yeah.
Just because, we were, provided with really an update on what the Fed is, projecting, providing guidance on what they believe will be the necessary path on monetary policy, going forward as we enter into 2025. So just jumping in briefly. Oops.
You might have to go a little closer to it.
Oh, okay.
But if not, I can,
Cassidy was looking for
I
you.
can-
I can be the
She can do
clicker.
it.
So Eileen, how's the job? Throw it to her. Just-
You
I
just
can
look at
click
us
if
and
I'm
we-
there. I'll just let you know.
Just tell,
Okay,
just
so
tell
go
her
ahead and-
next page, yeah.
Oh, it's not, maybe the battery stuff?
Oh, maybe
Is it
we
on?
should turn it on.
Oh!
Yeah, that clicker is.
I just changed the
Temperamental.
Yeah.
Okay, well, no, thank you, just don't turn it off, right? All right, we'll make sure that works. Yes, perfect.
There you go.
All right, so yeah, so clearly, looking at our, touch points here, a high-level view of really, what's happening, as it relates to interest rate. Of course, the key is the Fed funds rate, as the Fed has now made that additional 25 basis point cut at, their meeting that, closed on yesterday. When we add that to the, previous reductions that they've done since September 18th, it's been a full 1%
Yep.
drop in rates. And they're not technically over yet.
Yeah.
Because clearly, as we've seen, although inflation has somewhat stalled at its current levels, and we'll see that visually on a couple charts, economic growth, while it has been still relatively promising,
Yeah.
is looking to slow as well. And of course, we've started to see some uptick in the unemployment rate.
The GDP hadn't been predicted a year ago. It would be, what was it, 1.8%?
Yes.
Was the prediction last
3.1.
December? Yeah, right?
Yeah, the consumer just has continued to spend.
Mhm.
And of course, as we know, at the government level, local governments included in that, they have also continued to spend. So all of this spending is keeping the economy growing,
Mhm.
basically. But yeah, that unemployment rate has ticked up, but it's still in historically low levels. The Fed is expecting that it will continue to tick up throughout 2025. And so all of this has resulted in really what we would refer to as interest rates that have been relatively volatile, as we'll see. But rates are down from the height that they were back in October of 23. We are down about a clear 1% as well on that end. So this graph, what it is demonstrating is really what the market's expectations are for that overnight rate, which is the top line, that's the Fed funds futures. line, and then the bottom line is what the Federal Reserve's guidance has been. Now, this is where the slide is dated. Again, this was prepared
Yeah.
before the meeting. The Fed came out with an update on their guidance. They've actually moved their guidance to be more closely aligned with the market's expectations, which remain lower interest rates throughout 2025, but not nearly the pace of decline that was previously
Yeah.
expected. So at this point, really, both the market and the Fed are expecting over the course of the next 12 months that overnight rate will drop to a level which would be more in line with around 4%. So again, that's additional at this stage, about another 50 basis points reduction in that overnight rate that in essence would translate into 2 rate cuts. And at this stage, really, the market is anticipating that, most of those rate cuts will occur in the first half of 2025. And the latter half of 2025, that the Fed would pause. Now, of course, this is all very data dependent. We don't know, no one knows today, with the new administration coming in, what campaign promises will actually be initiated, how quickly they will be effective, which ones will go through the legislative process, which, as we all know, does take time to get things changed. And then, of course, the other factor is how it flows through into economic activity as well, and that will clearly be the driving force for rates. So at this stage, we know what we know today, but there's a lot that everyone doesn't know with a high degree of certainty as we move into 2025. So it's going to be, I would say, definitely, as we start into 2025, we would expect to see more volatility because there is this uncertainty, but we'll start to see more clarity as well as things do unfold. We touched on the inflation numbers. Again, the top graph is the personal consumption expenditure. That's the Fed's favorite measure. Its last read is at 2.8%, not down to the Fed's target of 2%, but it certainly has not moved up significantly here of late. It has moved up a little bit because we were touching down, I think, around 2.5% for a bit. But of course, the overriding concern always is that are these upticks, will they continue, or will it reverse course or just stabilize at its current levels? We compare that to the Consumer Price Index, which is a more widely known inflation measure, which we know, of course, that's where it topped out at that 9% level back in the summer of 2022. It has also, of course, dropped and is exhibiting about the same, I would say, activity as that personal consumption expenditure measure, in that it's pretty much stalled as well. So we're now seeing that Consumer Price Index at 2.7%.
Is it often that the indexes and inflation are almost simultaneously exactly the same?
No, it's generally more likely that there is more of a variation in them, and that's because the top number excludes that food and energy component, and the bottom number includes the energy and food component. And so we know that if energy prices spike, then that's gonna cause the bottom numbers to move up faster than the top numbers.
So they're talking about mid-year that those energy prices for movement of energy is supposed to considerably go up from what they had. NOPEC was at their meeting. The transport of fuel, or were you there for that one? That the price of the fuel isn't gonna go up, but being able to move it is gonna, they believe is gonna spike. And they're talking about first quarter, first half of the year, that going up.
Okay, yeah, I didn't stay for that part of the meeting.
Yeah.
So yeah, I mean, that would certainly then
That would.
contribute to higher prices.
Yep, and it's not gonna be
Yes.
because of the price of the fuel,
But
it's the price of, moving.
right,
Yeah.
which is a
Transporting.
cost of production,
Yeah.
yes.
I learned 2 things at that meeting.
Yeah. Yep.
Two, and the other one was, and this is how the weather in Anchorage affects here.
Yes.
So as the if it's colder there, then we'll have a warmer winter. If it's a little bit warmer there, we're gonna have a cold because of the way air circulates.
So what was their weather like?
It must be
What's the
freezing cold up there. 'Cause, I mean, we're supposed to have a nice one, but,
Yeah.
and that's how they judge how our fuel consumption is gonna be.
That's how they do
is-
their predictions. huh?
And I was shocked that it was Anchorage, Alaska is the one that they look at for
That's
our
an
weather
indicator.
here.
Yeah.
And it's the exact opposite.
Oh.
Wow, well, thank you for sharing that.
Yeah.
I did not know that.
No, I was able to go home after I heard that. I got my 2 pieces of
That's great, yeah. Yep.
Okay, but thank you.
This slide is of course, showing the economic growth in the U.S. Of course, as we've talked in the past, economic growth was very strong as the economy reopened post-COVID. We then had a little bit of a downturn, and then economic growth settled pretty much into, if we kind of average those numbers out, pretty much trend territory, which is for the U.S. economy around 3%. But the outlook going forward, and we'll say, we put just kind of a somewhat grain of salt on these outlook numbers because they tend to be a little more conservative than what actually happens. But the outlook is that economic growth through 2022 will be subpar.
22 or 25?
25 I meant,
Okay.
in that it will be at around the 2% level. So clearly, the economists out there are projecting slower growth into 2025. And, that would be driven, of course, based off of the fact that the consumer is, relatively tapped out. We have very high levels of credit card balances. We have increasing delinquencies on credit cards, delinquencies on auto loans as well. It's like the economy is bifurcated. We have these 2 segments. We have the lower income, which is really stretched, and we have the higher income consumer who, is benefiting from higher interest rates, benefiting from the stock market, hitting new highs and such, so they have that wealth effect. And they're the ones who really have been spending as well.
Not the last 10 days.
But not the last 10 years. I thought
So with fuel, the anticipation is we may be starting to produce fuel again.
Right.
Oil. How will that affect this, you think?
Well, the concept is, right, if there's more supply of fuel, of energy, whether it's natural gas or oil, that would lower the price. And so those lower prices, of course, would impact the price of heating your home, and lower the price of gas used for transportation. So not only on the individual level, but then also on the business level as well. And so that would be, again, the economics 101 says that is a positive.
I want you to look in your crystal ball. This is unfair, but what is the likelihood, if any, that grocers will lower prices anytime soon, like in 2025? Yeah. I'm kind of half joking, but
it's
It's all
It's
gonna
a
be the
problem.
fuel.
Yeah,
That's
a
the
lot
only
of it is
variant,
fuel.
really.
Yeah,
and
right.
what it costs a farmer to,
right.
it's gonna take them, I would think, about a year to recover
Right.
if things actually come down like they're talking about.
yeah, there's a lag.
The fertilizer and all
Yeah.
that stuff that has skyrocketed for them.
Yeah.
Yeah.
Well, and then to your point, the transportation, moving the,
Yep.
groceries, from the warehouses to the individual retail stores. Lower fuel prices will help that as well, help those costs. So yeah, I think, we are not gonna see lower. If I were to put money on it, I would say we would not see lower grocery prices for some time. Too many factors.
Yeah.
Yeah, unfortunately, I know I'm shocked, just as everybody else is when you go to the grocery store.
Bought a ham last week. Holy smokes.
Yeah,
Honey baked ham was like double the price that it was, yeah.
we had ham at Christmas, I said.
Yes, yeah, that's what.
Yeah.
We're eating this, yeah, what we're not eating, we're freezing,
That's
because we're
right.
not throwing it out.
That's right.
It was 11-pound ham cost like $116.
Right.
Yeah, yeah, it's like, yeah, all right.
Wow, is that?
So we want better news, Eileen. Come
I
on,
know.
Yeah.
pick it back up. Yeah.
Right.
Sorry, well, I do have good news, it's in the back half of the presentation.
All right, I just gotta wait to the end to get the good stuff.
Yeah, because clearly, right, when we look at the next piece here, which is the labor market. You know, the unemployment rate has ticked up a little bit. We're now at 4.2%. That's still historically low levels of unemployment. You know, when we think back 10, 15 years ago, and we talk about, you know, what is, you know, the sweet spot for unemployment, it was that 4 to 4.5% range. But since we're coming off of a low point of 3.4%, all of a sudden 4.2 seems, you know, rather egregious. But that being said, as we know, you know, unemployment, whether it's one person or 10 people, it still is a factor in that, you know, someone is not working that was previously working.
And isn't it also true that it's now taking on average, what, 10, 11 weeks for somebody to find another job
Yes.
after they've been out of work?
Mm-hmm.
And
Yes,
so
that has gone up.
that's
Mhm.
kind of gone up a little
Yes.
bit.
Yeah, so what we're seeing also along those lines, you're right, not only for those folks who have been forced to seek new employment, but those who maybe in the past were, you know, pursuing different opportunities at different companies, they are now staying put more so.
Mhm.
So there's less turnover in the current worker as well. And so that's pretty much from our perspective, when we look at that in conjunction with the fact that the job growth has not been robust like it was previously, that, and the number of job openings is nowhere near what it was.
Right.
That the labor market is probably a little more in balance, we would characterize it as.
And obviously, the Fed is looking at that as one big important variable in
Yes.
2025.
Yes,
If it stays that way,
Mhm.
or unemployment kind of creeps up a little bit higher,
right.
I know they said, what, 50 basis points in
Mhm.
25
Right.
they're looking at?
Right.
Maybe they
Right.
raise that. There's so much uncertainty.
Yeah.
I wish I did have a crystal ball,
Yes.
but I don't.
Right, and that's where, when we think about it, you know, we have this dual mandate from the Fed, stable prices, inflation.
Mhm.
So inflation, we know, is off the charts. They raised rates to bring it down. It's stalled, but it's not in an ideal spot yet. But we now had that unemployment picture start to deteriorate. So to your point, John, right, if it deteriorates faster and
Mhm.
and if inflation remains stalled, that could be a scenario where the Fed may need to pick up lowering rates at a faster pace. But if inflation picks back up, even if the labor market deteriorates, the Fed, you know, that puts the Fed in a tough spot. Because the solution to inflation is to raise rates, but the solution for their solution or their tool that they can use for the labor market is lowering rates.
Right.
So it becomes a question of which one becomes perhaps more egregious.
I'd like to see their crystal ball.
Yeah.
Yeah.
I can stay confused,
Well,
very confused.
and I think that's why Chairman Powell, we hear it all the time, particularly even at the press conferences when he's peppered with questions from the media, to that point of trying to get him to, you know, make a commitment to something. He always falls back on, we're data dependent.
Right.
It depends on where the data
We don't know.
lands,
Yeah.
because you know, there's so many variables there that impact things, and really the only tool per se that the Fed has is interest rates.
It's not ChatGPT.
No,
Okay. They're not using AI to make predictions.
no.
Not yet.
Not yet.
Right.
I do have a pivot point for real super local kind of consideration of all of this. This is why I have such great interest. I know Tony, same thing, and Sabrina. I want to be able to really promote the hell this coming year of our low interest loan program, GrowLink.
Oh, yeah.
So obviously, if the price of cash, if access to cash has become easier and cheaper, right, with lower interest rates, that makes my job a lot easier to promote it, right?
Right.
So if you were me, would you feel like there's going to be a stronger appetite come first quarter of 25, second quarter potentially, for people who have been waiting? And that's what I'm hearing still, and you'll hear my report shortly. But people have been really holding off because of the uncertainty with the Fed, though people don't really know about all that.
Right.
But the election too was a big mystery as to what the hell was going to happen. Now those two questions have been addressed. I have been feeling confident that in 25 we were going to see a real peak, a spike again in the amount of interest in the low interest loan program, because cash would be cheaper.
Right. Yeah, and I think that That's a very likely situation. I think, from the consumer's perspective, I would think they're also focused on perhaps just mortgage rates in general, because that tends to be something that's,
Is refi a
Broadcast?
thing again?
no.
Okay.
We had the 10-year treasury move up over 4.5%. We have some Wall Street firms putting out their forecast that they believe the 10-year treasury will be at 5%. Those,
Yeah.
and the 10-year treasury is really the reference point that establishes the mortgage rates. So as
Yeah.
long as that 10-year treasury is where it is today or higher, those mortgage rates are not going to come down.
Yeah. Got it.
Yeah.
It's gonna be a while before we see that 1%, 2%, 3%.
Yeah, I mean, we have to have some, pretty, different conditions than what we have today.
Yep.
And that kind of really leads to, if we just wanna flip to that last slide there, that really lends itself to that, oh, I gotta change the page, right? Lends itself to, right, what were the conditions that had those mortgage rates so low? And we can see it here. This is comparing, the orange line is the Fed funds rate,
Yep.
which the Fed sets, and then the blue line is the 2-year US Treasury, which is a benchmark interest rate for short-term investments, such as what we do for the county. But we can see how low those rates were over the time period, basically of 2008 to 2022, so almost 15 years. And when we think about really why were those rates too low, we had two major events. We had the housing crisis, and then of course we had COVID. So barring any major event, the unknowns out there, we don't have reason to believe that we would return to those lower level of rates, which therefore would mean, to your point, those 2.5%, 3% mortgage rates, they just don't become available because they're going to follow this trend of rates.
Correct.
And of course, we would not want to have a major event that would result in the Fed significantly lowering rates, even though that would benefit the homeowners.
I say that because context is important.
Yes.
And, throughout this last year, everybody that I talked to about property taxes, valuations, and all that are saying, look, if my taxes go up anymore, I'm not gonna be able to stay in my house.
Right.
Or, the argument is, well, you could sell your house and you can make a profit. Well, where the hell are you gonna live?
Right.
Where do you go? And based on this economic data and the forecasting here that I'm seeing is, we're not gonna see much movement in terms of people's confidence
Right.
being able to move out of their existing place and finding something affordable in the county or across the country for that matter.
Yeah, it's a real conundrum.
That's a good word.
Take an Al Green's
Yeah.
term.
Right, no, I mean, yeah.
It really is, because, we've gone through, as I said, this 15-year period where money was cheap. And so cheap money, gave folks the ability
Correct.
to do things that in this environment of a higher cost of capital, higher cost of borrowing, it just doesn't work.
Yeah. I mean, it's a great asset, your house,
Yes,
but if you don't have, where am I gonna live?
right,
If you can't answer that question, then it just stays right there.
yeah,
It stays as an asset, but you have to sit on it.
right,
And some people don't have a lot of runway left to sit on that asset.
right.
That's a problem.
And you're right.
Yeah.
And to your point, I mean, it's property taxes, it's homeowners insurance.
Yes,
Those
that's
are
right.
two major
Yep.
expenditures that they don't really have control over. So, yeah, it's a tenuous situation, there's no question, for a lot of folks. And, we're a diverse economy, the US totally, and as we know, there's the other side of the coin of folks for whom, it doesn't impact them as greatly.
Mhm.
Yeah.
Thank you.
All right, so now moving into the good news.
Yes, our
The
portfolio.
portfolio. So this is a snapshot of the portfolio as of the end of November. As we recall, last quarter when we talked,
We had a little more cash on hand.
we had more cash on hand.
Yep.
Moved $7 million into
Yep.
the investment portfolio, so we increased the investment portfolio. Now we have a nice balance still of cash and investments, and of course, we know.
The
property-
2080?
Yeah, property tax monies will be starting to roll in here,
When
so
do those
that'll
roll
restore.
in? First quarter?
Yeah.
Is that during the first quarter?
Collection.
Yeah, collections, right. And if the county's cash starts to get, where, a little tighter, where the, treasurer's office is, feeling nervous, we can always move money out of the investment portfolio back into cash. So that's always an option. So our weighted average yield on the portfolio stands at 3.46. Simple math, on the $881 million, that would generate $6.2 million of interest income on a 12-month forward basis. And that, of course, assumes that funds are reinvested at that 3.46% yield on average. So far this year, the interest received has, and this is just on the securities portion.
Yeah.
So this doesn't include the cash, doesn't include the monies in Star Ohio, which we know that has been a great generator of income throughout the year. Cash generated so far for the year has been just under 4.2 million.
Our weighted average yield has gone up since
Yep.
last quarter.
Yep, yeah, we were at 332
Now
last
at
quarter.
346, yeah.
346, right. So we always have to remember that, this is we've taken the long-term view.
Mhm.
Investments have been purchased over various interest rate environments, and when we just saw on the prior slide, up until 2 years ago, interest rates were, bouncing off of zero. So as those securities roll down the maturity spectrum, they will fall off the books, and as we're reinvesting, that will be at higher yields. So when we look actually at the buckets for the funds that are invested out in the 3 to 4 year and 4 to 5 year area, I can say that those funds are currently yielding over 4%. And that was one of our objectives, was to get those investments locked in at these higher rates, so that can provide that.
Correct.
That certainty of budget income can carry income over.
Right.
Yeah, it's interesting, in 2 meetings I've had with other clients, over the past 2 weeks, I've heard 2 kind of very interesting comments. One was a county, and they said that their, sales tax revenue has started to trend down. And another meeting was with the city, and they said their income tax collections have started to trend down. What? These are these canaries in the mine?
Yeah.
Yes.
So, because there are folks that, when they look at our investment portfolio,
Right,
that they would encourage us, I think for selfish reasons, to spend more,
Right.
to take that out. And this is not a very good environment to be taking money out of our investment portfolio.
right, yeah, right. We're starting to hear signs that economically,
The flashing yellows are flashing hard.
right,
Yep.
that it's good to have these monies in the investment portfolio that then can be drawn down upon,
Yeah.
when other revenue sources,
Yep.
get softer.
Because I've heard a few people wanting us to dip into that,
Yeah.
and that would be, I think, disastrous.
Yeah, it's interesting because one of the observations that we have shared with people sometimes is, when we think about the interest income off of the investment portfolio, it's one of the few opportunities that a public entity has to generate revenue without going back to the taxpayers.
Correct. Correct.
There is another way besides that? That's
I think that's
really
the only one.
I was gonna say,
Yeah.
that's the only way.
one. I
Yeah.
didn't want to use an absolute.
I'll go with, that's pretty damn absolute. But there's a chance.
And that's like 6.3 mil.
Yeah,
Yep.
right.
You're liking these numbers, Jackie?
Yeah, I like it when interest is high
Yeah.
in this environment.
You sound like you could work in the treasurer's office.
No, we're keeping her here. We're not letting her go no place.
Okay, so the next page here, this is just the recent purchases that we have made here over the past quarter. So we can see there was 23.2 million reinvested, average yield of 4.05%. Most of those investments were longer term, again, along in conjunction with our strategy of locking rates in.
Correct.
We do balance that with also though peppering in some shorter term, a year, 2 year, 3 year investments, just so we're not, overextending the
Yeah.
maturities. Because we wanna make sure that we have frequent maturities, and that the funds are allocated across the entire maturity spectrum.
Yes. Which, again, in our next meeting in March, things could have changed quite significantly, and we may need to make new decisions
Right.
about how to reinvest, how to move things around based on the economy
Right.
and the Fed.
Yep. And we like to remind ourselves that when we think in terms of the liquidity within a portfolio, there's a waterfall effect.
Uh-huh.
So we know we have the checking account.
Right.
So the checking account balances, that's the first
Right.
source of liquidity. The second source is the other liquid assets, like the Star Ohio account
Right.
and the money market account. I think it's at Home Savings.
Mhm.
So those would be the next lines that would be pulled. And then the third source would be then pulling money out of the investment portfolio. So we always wanna also, along those lines, be very mindful of the dollars that are in the first two liquidity buckets, as well as the
Mhm.
dollars that are in that third liquidity bucket, that backup liquidity, where we
Right.
know we would have that as a resource to be able to pull from. And if it's not needed, if, the first two buckets, that relationship is in a good spot, then we can continue to reinvest based on a strategy.
Yep.
So this slide, what we're showing here is this is the projected interest income that will be generated from the securities portion only. So of course, we're showing 2024. So far, we only have one more, in this case, half a month of interest to collect. So the 2024 interest income will be just shy of $5 million. Again, as we were, reinvesting funds, the lower yielding securities falling off the books. 2025, 20, and 26, we can see pretty stable
Mhm.
interest income for the next 2 years. So, that provides that budget certainty, and again, will help bridge that gap if the county starts to experience, some of the downturns and turns in revenues that we're hearing from, other sources. And then, of course, as we're reinvesting funds, this will be filling up, increasing those buckets, as well as filling up 27, 28, and 29. Because of course, those bars are lower just by virtue of the fact that you have lesser mature securities contributing income in those years.
Right.
Yeah, it's interesting because on the August report, the 25 number was closer to like 5 million. And now we're approaching closer to 6. So the reinvestment options have certainly, adding a lot of interest income. And
That's great.
And since many of those securities were longer term, it really made a big difference on that 28, 29.
I mean, that's in 28, 29, you go from 6 to 1.
Right,
I'm not sure I grasp why you projected you're losing,
how much income?
yes.
Because this is only based on the securities in the portfolio, so
Okay.
we're not assuming we're reinvesting.
Okay.
So so when we look at, what makes up the income numbers in 25, that would include securities that mature in 25, 26, 27, 28, 29. And then when we look at 26, well, now we no longer have the 25.
Right.
So we're only looking at securities mature 26, 27, 28, 29. And by the time we get to 28, we're only capturing the securities that mature in 28 and 29.
Okay.
So it's just that,
That accordion happens on a regular basis
Yes.
every
Yes.
5-6 years?
yep,
Okay.
so right. And we're looking to expand it out on the longer end so that, it fills up those longer term buckets.
Okay.
Yeah, so this is the historical comparison. Again, this is just taking the portfolio size, the weighted average yield, the weighted average maturity, and with the weighted average yield, multiply then that simple against the portfolio size as of the point in time, just to provide a 12-month forward interest income number. So we can see, for 23, if we at the end of '23, we had 166 million yielding 312. That on a 12-month forward basis would generate about $5.2 million. That's about where we're at for 24's income. So this is always looking ahead 1 year. Okay. Yeah. So it's a good trend. More
It
cash.
is. It is.
Interest rates on the portfolios have greatly improved, and that has all in combination translating into more interest income for the county. And as we've demonstrated, our objective to have that interest income be repeatable is part of the strategy as well.
Yeah, yeah, that's a good.
Any other questions, comments?
No, ma'am.
Okay, balance of the report, of course, is the portfolio holdings. This is the, in the weeds, the detail of all of the individual securities that do make up these numbers.
Yeah.
A lot of detail here. This is what we get into, all the detail. So again, as we know, as interest rates move up and down, that unrealized gain or loss column varies as well. Our intent is to purchase investments with the intent to hold to maturity. However, we will opportunistically capture a loss if we can reinvest and make more money by reinvesting those funds and recover that loss. Okay.
All right. Thank you very, very much. Do we need to vote on accepting this into the record?
We do.
Okay.
I'll make a motion to accept the report for my,
I'll second that.
and that's roll call, and motion passes. Did we do approval of minutes? Did we?
We did.
We did that? Okay.
We did.
wanted to Make sure, okay.
We do it very quickly.
Yep.
And now I will talk
Growlink.
about Growlink.
Yep.
So I mentioned briefly a little bit of background about the Growlink program, and Tony, you've been to all these meetings. Eileen, you've been to all of them with me as well over the last year plus now. We were doing okay when I first came on board in terms of the numbers of loan applications that we were getting and the amount of interest that we had. And we noticed a trend several quarters ago where we looked at, okay, where are the loans going, and in what sector are they going into? And we saw that homeowners were a small piece of the pie overall, and that commercial trucking was a big one.
The biggest, yeah.
That has fallen off, and overall interest has diminished. And I say that reluctantly, but that's the truth. In spite of the fact that, and Tony, you know this, Eileen, I've shared these stories with you. I couldn't have promoted it any more than I have. I was at every township in Portage County over the last 6 months, all 18. And I promoted the hell out of the Portage Growlink program because it's a good program. But what I heard over and over, and I said this last meeting as well, is, John, we're just not there yet. We're holding off because we don't know about the economy, and we think we're hearing that interest rates might come down a little bit, so I'm going to hold off until post-election, and then I would say, well, the Fed is going to lower interest rates. Well, now we've come down a full point. That's just happened recently. We know that since September 18th, and then through November and now in December. I do believe, and I am a champion of this, and I know I can sound a little blue sky about it optimistically. That's my approach to it. But what I have heard repeatedly, I think we're going to see a big uptick in interest and in appetite come first quarter, second quarter of next year. And by the time we meet again in March, we're going to see that more people have said, you know what? I'm taking out one of those loans through the county because it's 1 to 3% below market. And now market is lower. Cost of cash has been diminished significantly. I've been wanting to do this home improvement. I'm now gonna take out this loan. Or, as I talked to this young business fella in Suffield, told me, John, after November, give me a call, and going into 25, let's have a conversation about a small business loan. I want to start a small business. There is nothing that makes me happier in this world. Tony knows me. I want small businesses to feel like they can get started and launched here in Portage County and stay here in Portage County. That would be a great legacy for me to leave with the county, is that we've gotten some small businesses up and off the ground over the next 6, 7, 8 months. And I do believe that there's interest and an appetite for it, but it's not going to happen. I wish I would have had better news to report than what I have here. I talked to a woman last week who said, John, give me the loan program details. Who do I need to talk to? Hometown, Portage Community. I said, it's your choice. You can talk to either one of them. I know one of the other things that we talked about at the last meeting was, are our lenders at Hometown and at Portage Community doing what we hope that they're doing? So I talked to Eric Decker at Portage Community Bank. He's the chief lending officer over there. And he assured me that he's getting some bites, but and there was a couple where the credit just wasn't there for them to do it. The problem with the banks, and I'm saying this, I know I'm on public right now. The problem is they've got other loan tools in the tool shed besides GrowLink. And so it's incumbent upon me to always remind the lenders on the ground at both Hometown and at Portage Community, A, do you have enough of the loan brochures? They can't put this up on their websites. They're prohibited from marketing it. Yep. They have to put their product, but they are not allowed to promote the county's loan program on their website per se. See?
Can we promote that on county website? Do you have GrowLink on?
I do,
Okay.
I do. But could we do a better job of promoting it? Hell yes.
Get to it, big guy.
Yep. So that's my goal. And you won't be here to hear me, but I'll call you and I'll let you know how things go.
And I will not watch this, I guarantee you.
But it's riveting. It's riveting. But come March, I really truly want to be able to come back and say, hey, we've gotten some of these now, and we've got small businesses that have taken the bite too. You know, because it is a safe, it's a low cost loan. And, you know, I tell people all the time, you can, as a small business, you can take up to $250,000 out for operating costs.
How much do we have there right now?
Over $1 million.
Okay.
Yeah. Yep.
My time for start business.
Yes. So that's my job. Job number one is to promote the hell out of this and come back with a good report for y'all. And
Well, you've got a
in
good
March.
foundation going, John, so
Yeah.
that's a good thing as you're going into 25. So with all the groundwork you've done over the last 2024, so
thank
you're in
you.
a better place than you were last year.
That is true. That's true.
Right.
Yep.
Anything else come for the committee?
No.
Hearing none, I will make a motion to adjourn.
I'll second that.
And roll call, and meeting will be adjourned at 2:48.